Welcome back to Investment IQ Insights. If you're serious about growing your wealth and staying ahead in the investment game, you've come to the right place. Before we dive in, go ahead and hit that subscribe button and ring the notification bell so you won't miss out on any future videos that could be the key to your financial success. Today, we're diving into the world of technology ETFs. Investments that offer instant diversification across some of the most innovative and profitable companies in the world. These ETFs are not just great for the short term. They make for excellent long-term holdings because they give you exposure to the entire technology sector, which is expected to continue driving global growth for years to come. Now, let's talk about how we're picking these winners today. You've probably heard about ChatGPT, an AI tool that's revolutionizing countless industries, including finance. With its ability to analyze massive amounts of data and provide insights in real time, ChatGPT can help investors like us uncover hidden opportunities in the market. We're leveraging AI to predict which technology ETFs could make you rich in the coming years. Why technology, you ask? The tech sector is at the forefront of innovation, shaping the future with advancements in AI, cloud computing, semiconductors, and more. As these technologies continue to evolve, the companies leading the charge are expected to see substantial growth, making tech ETFs a smart, diversified bet for building long-term wealth. So let's get started. First up is the Invesco QQQ Trust, better known as QQQ. This ETF is one of the most popular in the world, and it's easy to see why. QQQ tracks the NASDAQ 100 index, which means it provides exposure to 100 of the largest non-financial companies listed on the NASDAQ stock market. These are companies that are at the forefront of innovation, including tech giants like Apple, Microsoft, Amazon, and Nvidia. Morningstar rates QQQ with a stellar 5 stars, reflecting its consistent outperformance over time. Let's take a closer look at its returns. Over the past 10 years, QQQ has delivered an average annual return of approximately 17%, making it one of the top-performing ETFs in the market. Over the last 5 years, it's maintained a strong return of about 20% per year. And even in the past year, it has held up well, despite market volatility. The top holdings in QQQ are some of the most dominant tech companies globally. Apple and Microsoft together make up over 20% of the fund's total assets, providing significant exposure to the leading drivers of tech growth. With great returns comes higher volatility. QQQ is more volatile than some other ETFs, so it's best suited for investors with a higher risk tolerance. However, it's hard to beat its historical performance. The expense ratio is just 0.20%, which is relatively low considering the high growth potential of its holdings. Next, we have the Vanguard Information Technology ETF, ticker symbol VGT. This ETF is a great choice for those looking to invest specifically in the information technology sector. VGT tracks the MSCI US Investable Market Information Technology 25/50th Index, giving you exposure to nearly 400 tech companies, including big names like Apple, Microsoft, and Visa. Morningstar also rates VGT with a 5-star rating, acknowledging its strong performance and diversified portfolio. Over the past 10 years, VGT has achieved an impressive average annual return of around 18%. Over the last 5 years, it has also performed remarkably well, with average returns of about 22% per year, and its 1-year return is in line with market trends. Apple and Microsoft again lead the pack in VGT, but it also includes exposure to companies like Visa, which provides a broader mix of technology-driven industries, including financial tech. VGT is slightly less volatile than QQQ, making it a solid choice for investors who want exposure to tech with a bit more stability. The expense ratio is just 0.10%, one of the lowest in the industry, which makes VGT a cost-effective option for long-term investors looking to maximize their returns. Let's shift our focus to a more specialized area within technology. Semiconductors. The VanEck Semiconductor ETF, ticker symbol SMH, is an excellent way to invest in the companies that are powering everything from smartphones to artificial intelligence. SMH tracks the MVIS US-listed Semiconductor 25 Index, giving you exposure to the top 25 semiconductor companies worldwide, including leaders like NVIDIA, Intel, and ASML. Morningstar gives SMH a solid 4-star rating, reflecting its robust performance and growth potential in a niche sector. Over the last 10 years, SMH has delivered an average annual return of about 21%, with especially strong performance over the past 5 years, where it has averaged nearly 30% per year. Even in the last year, it has managed to post respectable returns, demonstrating the ongoing demand for semiconductors. NVIDIA is the top holding in SMH, making up a significant portion of the ETF's assets. This is a bet on the future of AI, gaming, and data centers, all of which are heavily reliant on semiconductors. Given its focus, SMH is more volatile than broader tech ETFs, but the potential rewards can be substantial if the semiconductor industry continues to grow. The expense ratio for SMH is 0.35%, which is reasonable given its specialized exposure. Next, we have the Technology Select Sector SPDR ETF, ticker symbol XLK. XLK offers exposure to a wide range of technology companies by tracking the Technology Select Sector Index. This includes some of the biggest names in the industry like Apple, Microsoft, and NVIDIA, but also covers other areas such as IT services and software. XLK has a 5-star rating from Morningstar, underscoring its consistent and strong performance over time. Over the past 10 years, XLK has delivered an average annual return of around 17%, with solid 5-year and 1-year returns, making it a reliable choice for tech investors. With top holdings in Apple, Microsoft, and NVIDIA, XLK is heavily weighted towards the biggest players in tech, but it also provides diversification across different technology subsectors. XLK strikes a good balance between risk and reward, offering broad exposure to the tech sector with moderate volatility. The expense ratio is a very competitive 0.10%, making it one of the most cost-efficient options for tech investors. Finally, we have the iShares US Technology ETF, ticker symbol IYW. IYW provides exposure to a broad range of US technology companies by tracking the Russell 1000 Technology RIC 22, 545th capped index. This includes a mix of large-cap and mid-cap tech companies, with top holdings in Apple, Microsoft, and Alphabet, the parent company of Google. Morningstar rates IYW with 4 stars, reflecting its strong but slightly more volatile performance. Over the past 10 years, IYW has delivered an average annual return of around 17%, with robust returns over the past 5 years and a solid showing over the last year. IYW's top holdings are dominated by the biggest tech giants, but it also provides exposure to other emerging players, giving it a broad scope within the tech sector. While IYW carries a moderate level of risk, it offers a slightly broader exposure to tech than some of the other ETFs we've discussed. The expense ratio is 0.39%, which is on the higher side but still reasonable considering its performance and the range of companies it covers. That wraps up our look at the top 5 technology ETFs that AI predicts could make you rich. Each of these ETFs has its own unique strengths, so which one is right for you? That depends on your individual risk tolerance, investment goals, and time horizon. If you enjoyed this video, don't forget to give it a thumbs up. And if you like this content, we bet you'll enjoy the 2 videos currently appearing on your screen. Go ahead and click on one of them now to continue gaining valuable knowledge on finance and investing. Thanks for watching, and I'll see you in the next one.